Coming to common size statements. What are common size statements? Common size statements are the statements which express all the items of financial statement as a percentage of some measure of the size of the enterprise. Now students, this definition makes it very clear that these statements express all the items of financial statement as a percentage of some common measure. Now students, let us recall the comparative statements that we had done earlier. In comparative statements, we find absolute change for the period in comparison. And based on that absolute change, we then proceed to find the percentage change. But in common size statements, we are not required to find absolute change. Rather, we are required to find the percentage expression for each item of the 2 years in comparison based on some common measure. What this makes clear is that you are actually not comparing the two figures. What you are actually trying to do is you are trying to compare the two percentages. Now, what can be the common measure in this case? The common measure can be different for different statements. Like for example, in case of profit and loss account, the common measure can be net sales, and in case of balance sheet, that is balance sheet position statement, the common measures can be taken as assets or liabilities because they both are equal. So when each and every percentage is expressed on a common measure, it becomes easier to compare it. This kind of analysis, that is based on common size statement, is very useful for comparing the figures or the businesses in which there is a great disparity in terms of size or in terms of time. Like for example, let's say A Limited in first year had 2 factories. Now this year A Limited has acquired, that is the second year, it managed to acquire a new business or business of some existing firm, because of which it has now 5 different factories. Now students, it can be clearly seen that the scale of operation in the first year was much lower as compared to the scale of operations in the second year because of the acquisition of new business. Now since the scale is very different, the figures, if we try to calculate on the basis of comparative statements, they would be very different, and as such that comparison would be meaningless. So in this case, what we can do is we can follow common size statements. What this will enable us is to calculate the percentages in the first year and the percentages in the second year, and then we can compare these two percentages. So students, common size statements are the statements in which all the figures are expressed as a percentage of a common measure, and that common measure can be different for different statements. Like we had just discussed, in case of profit and loss, the common measure can be net sales, and in case of balance sheet, the common measure can be assets. Based on these percentages, we can carry out our analysis and find out meaningful results. Now let us move on to the format of common size income statement or common size profit and loss account. The format of common size profit and loss account appears like this. Common size profit and loss account of, here the name of the company appears, for the year ending, for the 2 years that we are actually trying to compare. Now then we have particulars column, previous year figure, then as a percentage of sales. Now in this case we are taking net sales as the base. So percentage of net sales for the previous year. Then we have current year, and the last column is as a percentage of sales for the current year. Now students, the format in the particular columns remains exactly the same as in case of comparative statements. It is only the difference in the calculation that is there. So just to revise it, in particulars we have gross sales if they are given, less returns in case given. On subtracting these two figures, we will get net sales less cost of goods sold, less cost of goods sold. We will have gross profit. So students, if gross sales are given, we'll subtract sales return, we'll get net sales. Out of net sales, we will deduct the cost of goods sold, then we'll get gross profit. Then out of this gross profit, we will deduct any kind of indirect expenses. Remember, these indirect expenses can be given separately also, like office and administration expenses, selling and distribution expenses, and so on. So all the indirect expenses would be subtracted and we will get operating profit. Out of this operating profit, we will then deduct miscellaneous expenditures, that is miscellaneous expenditures, or we can also write it as other expenditures. We will add miscellaneous incomes or other incomes. Totaling it out, we will get net profit before tax. Net profit before tax. Out of this, deduct income tax. Once it has been deducted, we will get net profit after tax. After tax, this would be the final figure. Now, the percentages would be calculated on the basis of these figures that we will be calculating, and they will be calculated on the basis of sales for the respective year. Remember, there is no comparison, direct comparison of the previous year and the current year. That is, you need not subtract these figures, you need not add these figures. What you have to do is, you will take net sales as the base and calculate percentage for all of these figures, taking net sales as the base for the respective year, and derive all these percentages. Let us understand this by taking an example.